Let me tell you something right now, and I need you to really hear me on this one. XRP's $1,000 liquidity shock is not some fantasy headline. It is a structural conversation that Wall Street has already started having behind closed doors, while retail is still arguing about $1, $2, $5. You cannot make this up. The big players are not looking at XRP like a meme coin. They are not looking at it like a swing trade. They are looking at it like plumbing, financial plumbing for a new global system. And when you understand liquidity at scale, when you understand what happens when trillions of dollars need to move instantly across borders, you start to see why a four-digit XRP isn't about hype, it's about math. Institutions don't move early because they're emotional. They move early because they see infrastructure forming. And I'm telling you what, the same people on Wall Street who laughed at crypto in 2017 are now building exposure to blockchain rails quietly, strategically, without ringing bells. Retail is watching candles, they're watching YouTube thumbnails. Meanwhile, liquidity corridors are being tested, regulatory clarity is forming, and XRP is being positioned as a bridge asset in a world drowning in debt and inefficiency. Ask yourself this: why would serious capital even glance at XRP if there wasn't something bigger unfolding? The answer is utility. The answer is settlement speed. The answer is cost efficiency at scale. And when liquidity gets thin during a supply shock, price doesn't move politely. It teleports. That's the shock. That's what people don't understand. $1,000 doesn't happen in a straight line. It happens when supply disappears and demand has no choice but to bid up aggressively. Guys, if Wall Street is preparing for that scenario before retail does, that tells you everything about asymmetric opportunity. So here's what I need you to do right now. Zoom out, think bigger, and stop measuring XRP against yesterday's narratives. This is about global liquidity transformation. If you're serious about being positioned before the mainstream wakes up, you already know what that means. Alerta Roja USA. Pay attention. The signals are not loud, but they are there. Now let's talk about what a liquidity shock actually means, because this is where most people get confused. They think it's hype language. It's not. A liquidity shock happens when demand surges into an asset that has limited available supply at market price. XRP has a fixed supply. A large portion is locked, held, or strategically positioned. If institutions begin allocating even a fraction of cross-border settlement flow through XRP, circulating liquidity tightens fast. And when liquidity tightens, volatility expands. I really do believe many investors underestimate how violently price can react when order books thin out under institutional pressure. Wall Street understands order flow. They understand depth, they understand slippage. Retail looks at price charts, institutions look at liquidity maps. Big difference. Think about this logically. If major financial entities anticipate regulatory clarity and begin pre-positioning before public confirmation, they're not doing it for a 10% move. They're preparing for structural repricing. And here's the part that should wake you up. Institutions never wait for the headline to go mainstream. They front-run probability. If they believe XRP will become a settlement layer between banks, central banks, and payment networks, they accumulate quietly during disbelief. Then, when adoption becomes obvious, retail provides exit liquidity at much higher prices. That's the cycle. We've seen it in equities, commodities, real estate. Why would crypto be different? And let's not forget global macro pressure. Banking instability, currency devaluation, rising debt loads, all of this increases demand for faster, cheaper settlement solutions. XRP was built specifically for that. So when people laugh at a $1,000 scenario, I ask them, have you calculated total addressable liquidity markets? Have you modeled what happens when trillions need a neutral bridge asset? Or are you just reacting emotionally to a current price? Because Wall Street does the math. They always do the math. And if they are seeing liquidity compression forming before retail, that's your signal, that's your window. Alerta Roja USA. Don't sleep on infrastructure plays while chasing noise. Let's really slow this down and go even deeper, because if you don't understand the psychology behind this market, you will always feel like you're chasing it instead of positioning ahead of it. Market psychology is not just important, it is everything. Retail investors, and I say this with respect because most of us started there, want emotional safety. They want confirmation. They want CNBC to say it's okay. They want the lawsuit resolved. The headline's positive, the price already moving, the influencer's excited. That's when they feel comfortable pressing buy. But institutions, they don't wait for comfort. They wait for probability. That is the separation. And that separation is where wealth transfers happen. When XRP was under regulatory pressure, when uncertainty was high, when fear was loud, that was not just chaos, that was a pricing event. Smart money looks at chaos and asks one question: is the market mispricing future potential because of temporary uncertainty? That's it. They model scenarios. What if regulatory clarity eventually arrives? What if cross-border payment demand keeps increasing? What if liquidity corridors expand quietly during the noise? They assign probabilities to each outcome. And if the downside looks capped while the upside includes structural repricing, that's asymmetry. I'm telling you what, asymmetry is the holy grail of investing. You don't need to be right 100% of the time. You need limited downside and explosive upside. Now think about where we might be right now. A liquidity shock is not a viral moment. It's not fireworks on social media. It begins in silence. It begins when positioning happens before narrative consensus. It begins when partnerships don't make front-page news but still expand infrastructure. It begins when corridors activate and transaction volume quietly increases. You won't always see it in a single daily candle. You'll see it in subtle shifts. The conversation changes from "will XRP survive" to "what happens if XRP scales?" That shift from survival to scalability is massive psychologically. And once the broader market narrative flips from doubt to inevitability, that's when acceleration happens. Momentum traders don't care about the 5-year thesis. They care about breakout confirmation. Algorithms don't debate regulation. They chase volume and volatility. When those forces activate simultaneously in a supply-constrained asset, price discovery speeds up dramatically. It doesn't climb politely, it jumps. And then everyone looks back and says, how did we miss that? You didn't miss it. You ignored the positioning phase. Think about historic supply squeezes across markets. They never gave long warnings. They built pressure quietly and then released it violently. Liquidity shocks are pressure events. If circulating supply tightens while demand expands, even slightly, repricing can be aggressive. And if Wall Street saw that structural setup forming before retail, that means they understood the cycle before it matured. So now the real question becomes personal. Are you aligned with long-term utility, or are you emotionally reacting to short-term noise? One mindset builds conviction during boredom and doubt. The other chases green candles and panics during red ones. I really do believe XRP is standing at a crossroads between being treated as a speculative token and being recognized as a liquidity instrument. If that perception flips decisively, valuation frameworks change overnight. Price will not reflect today's skepticism. It will reflect tomorrow's throughput demand. Alerta Roja USA. Cycles reward those who understand them before they become obvious. All right, let's break this down and really expand on the numbers, the mechanics, and why this isn't just speculation. It's strategy, it's infrastructure, and it's psychology all rolled into one. When we talk about XRP reaching extreme valuations, we're not talking about a casual guess. We're talking about real liquidity throughput scaling. That means more than just people buying on Coinbase or Binance. It means banks, payment processors, and financial institutions using XRP as a bridge currency to move trillions of dollars in real time across borders. This isn't a fantasy. It's the exact design of the XRP ledger. And when adoption scales like this, every single transaction contributes to tighter liquidity in the market. That's why a liquidity shock is so different from normal volatility. The mechanics are not emotional, they're structural. The system has a finite supply, but demand can grow exponentially as cross-border payment volumes increase. This isn't a theory, it's math. And when institutions recognize that math before the headlines flip, that's where opportunity emerges. Timing is everything here. Wall Street doesn't need absolute certainty to act. They need an edge. They don't wait for a viral tweet or a mainstream news story. They position based on probability, on models, on structural insight. If they see regulatory clarity starting to emerge while infrastructure strengthens, payment rails integrating XRP, liquidity networks activating, settlement corridors coming online, that's enough to justify early accumulation. Retail, on the other hand, waits for price confirmation, the green candle above previous highs, the social proof. And by the time that happens, the risk-reward landscape has already shifted dramatically. That's the asymmetry I keep talking about. One side acts on insight, the other side reacts to confirmation. One side builds generational positioning, the other side builds regret. Ask yourself this: if you truly believed XRP could become a core component of cross-border settlement, would you wait until everyone else is convinced, or would you position quietly during the doubt phase? That's the real question, and the difference is massive. This is why liquidity shock is more meaningful than price targets. It's about capital flow versus speculation. It's about system-wide adoption versus emotional trading. Now let's talk about the actual scenario, $1,000 XRP. This is not a casual guess. It's the byproduct of extreme demand meeting constrained supply. The tokenomics are clear: a fixed supply, a portion held in escrow, strategic institutional accumulation. That's the environment for a liquidity-driven repricing. Could this take years? Absolutely. Could it accelerate faster than expected if macro events intensify? Banking crises, currency devaluation, liquidity stress? Also, yes. Markets don't wait for us to feel ready. When financial stress increases, banks look for efficiency, speed, and reliability in moving collateral. That's exactly what XRP was designed for. The bridge functionality becomes critical. It's not just speculation, it's systemic. And when structural demand spikes while circulating supply is constrained, prices can reprice violently, often in ways retail never anticipates. That's why preparation beats reaction every single time. Finally, consider the signals that matter. Are institutional partnerships expanding quietly? Are transaction volumes and utility metrics increasing? Is regulatory clarity improving? These are the signals smart money tracks. Not tweets, not memes, not Reddit hype. The institutions see this, they position, and they accumulate while retail debates and panics. The difference between those who understand the system and those who don't can be millions in unrealized gains. Alerta Roja USA. This is a warning and an opportunity, not fear, but awareness. If you want to align yourself with real structural shifts instead of reacting to short-term volatility, this is the moment to observe, learn, and position. Timing, alignment, preparation. That's how fortunes are built when liquidity shocks hit. And with XRP, that possibility is very real, very tangible, and unfolding right now. All right, guys, let's really break this down and get granular, because the bottom line here is absolutely critical to understand. XRP's $1,000 liquidity shock is not some promise or speculative clickbait. It's a realistic possibility born entirely from infrastructure scaling and the mechanics of capital flow. We're talking about a fixed supply asset being positioned as a global bridge currency at a time when financial institutions, payment networks, and liquidity corridors are quietly expanding their capabilities. Wall Street doesn't need to announce their moves. They don't need to post on Twitter or make flashy headlines. They model, they calculate, they allocate based on probability, not emotion. And that's exactly what makes them dangerous in the market in a good way. They spot asymmetrical opportunities before retail even knows the game has changed. If even a small probability exists that XRP could experience extreme upside while downside remains contained, that is enough for them to deploy billions strategically, quietly, and systematically. That's how serious money moves. Retail, on the other hand, often waits for emotional comfort. They wait for price validation, for confirmation bias to kick in, for news cycles to make them feel safe. And while that's human behavior, it's exactly why retail often misses these structural events. Markets reward conviction built on research and understanding, not comfort built on headlines or social media hype. I really do believe we are entering a pivotal phase where utility-backed crypto assets begin separating clearly from pure speculation. This isn't hypothetical. When that separation becomes obvious, capital rotation will be aggressive. We're not talking about incremental gains here. We're talking about large-scale capital moving into fixed supply assets that suddenly become critical for infrastructure use. And when that happens, the market doesn't move slowly. It doesn't climb politely. It creates shockwaves, I mean real, sudden, violent shifts in liquidity and pricing, and XRP is structurally designed for this kind of scenario. It's not just a story of price appreciation, it's a story of liquidity compression and demand explosion. Ask yourself, are you positioned for that kind of structural change, or are you still reacting to daily candle patterns and noise on social media? Because when liquidity tightens and demand spikes, you're not going to have time to debate or wait for a confirmation tweet. Price will adjust, narratives will flip, and suddenly everyone will claim they always believed. That's how cycles work. It's psychology and mechanics operating simultaneously, and you cannot make this up. Those who understand it early are the ones who capture the real gains. Now, if you look at the bigger picture forming right now, it's all lining up. Regulatory clarity is emerging, institutions are quietly accumulating, global macro instability is increasing, and XRP's infrastructure is maturing. These are not small signals. They are the exact conditions that precede liquidity-driven repricing events. The opportunity is structural, not speculative. It's about being aligned with the mechanics of the system rather than chasing short-term hype. And let me tell you, when these pieces align, the market can move faster than most anticipate. Staying informed, rational, and patient is not optional. It's essential. Alerta Roja USA is not about fear, it's not hype, it's awareness. Awareness that positions you to act with intention before the masses react emotionally. Because when the liquidity shock hits, the people who understand it first are the ones who benefit after it. This is your chance to observe, analyze, and position for what could be a generational financial event, and that's why this conversation matters more than any daily price update or social chatter. Stay sharp, stay strategic, and make your move with clarity because structural transformation waits for no one.